Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of how economic trends shape investment strategies in 2025. Technological advancements shaping economic landscapes. Technology is reshaping economies at a pace we've never seen before. It's driving efficiency, creating new industries, and altering how businesses operate. For investors, staying informed about these advancements isn't optional, it's essential. Below, we'll explore 3 major technological forces and their impact on financial systems and investment strategies. Role of artificial intelligence in financial systems. Artificial intelligence, AI, is becoming the backbone of modern financial systems. From analyzing massive datasets to automating repetitive tasks, AI enhances speed and accuracy in ways that traditional methods simply can't match. For investors, this means smarter strategies and better decision-making. AI-powered algorithms now analyze stock trends, predict market movements, and even create tailored portfolios for individual investors. For example, robo-advisors use AI to craft investment strategies based on your goals, risk tolerance, and timeline, all without requiring human intervention. This makes investing more accessible and efficient. Beyond that, AI improves fraud detection and risk management. By sifting through vast amounts of transaction data, it identifies patterns that signal unusual or suspicious activity. Banks and financial institutions now rely on these systems to protect assets and prevent losses. How does this affect you? It's simple. The rise of AI levels the playing field. Whether you're a seasoned investor or new to the market, these tools provide insights once reserved for top-tier analysts. But as AI integrates further into financial systems, it's worth considering how much of your portfolio will depend on technology-driven insights. Green technologies as economic catalysts. Green technologies aren't just good for the planet, they're good for the economy too. As governments and businesses commit to reducing carbon emissions, demand for renewable energy and sustainable practices is skyrocketing. This creates opportunities for industries to grow and investors to benefit. Take renewable energy as an example. Solar and wind power are not only becoming more affordable but are also receiving heavy backing through subsidies and investments. Companies in the clean energy space are experiencing rapid growth, making them attractive targets for long-term investors. The push for sustainability isn't limited to energy. Sectors like agriculture, construction, and manufacturing are being transformed by eco-friendly innovations. Companies adopting green practices often see cost savings through energy efficiency and gain consumer trust in a market that increasingly values sustainability. For investors, green technologies represent a long-term shift rather than a passing trend. Whether you're buying into renewable energy ETFs or investing in companies focused on sustainability, the movement toward a greener economy offers both financial returns and the chance to align with broader societal goals. Digital currencies and blockchain economics. Cryptocurrencies and blockchain technology are disrupting traditional financial systems, creating both opportunities and risks for investors. Unlike fiat currencies, digital currencies like Bitcoin and Ethereum operate on decentralized networks, offering transparency and accessibility. But how does this connect with investments? For starters, blockchain, the technology that powers cryptocurrencies, has applications beyond digital money. It's being used to enhance supply chain transparency, streamline financial transactions, and reduce fraud by providing tamper-proof records. Companies leading innovation in blockchain technology are becoming hot investment targets, much like tech startups in the early 2000s. However, cryptocurrencies themselves are highly volatile. Prices can swing dramatically, driven by speculation, regulatory news, or technology updates. While some investors see this as an opportunity for quick profits, others recognize the long-term potential of decentralized finance, DeFi, systems to reshape banking, lending, and even governance. Investing in cryptocurrencies requires caution. While they offer high growth potential, they also carry risks like market manipulation, regulatory crackdowns, and cybersecurity threats. Diversifying your portfolio and investing only what you're willing to lose can help manage these risks. Blockchain is not just an emerging trend, it's building the infrastructure for what could become the next phase of the internet. Whether you're interested in cryptocurrencies or the broader applications of blockchain, it's clear that these innovations are changing how wealth is created, stored, and transferred. Are you ready to adapt your investment strategy to this new frontier? Effect of central banks and monetary policy. Central banks hold some of the most powerful tools in shaping the economy. Their decisions touch every corner of the financial world, from influencing consumer spending to steering investment trends. For investors, understanding how central banks operate and how their policies ripple through markets can provide a significant edge. Let's explore 2 key ways they influence investment opportunities. Interest rates and investment opportunities. Interest rates, set by central banks, act like a thermostat for economic activity. A rate hike often cools things down, while a rate cut tends to heat things up. But what does this mean for investors? When interest rates rise, borrowing becomes more expensive for businesses and consumers. Companies may delay expansions, while households reduce spending, leading to slower economic growth. In such an environment, bonds usually become more attractive. Why? Higher rates increase bond yields, offering a safer investment with decent returns. But at the same time, stock markets can take a hit. Growth-focused companies, especially in sectors like tech, feel the pinch as financing costs climb. On the flip side, rate cuts can create a surge of opportunities. Lower borrowing costs encourage companies to invest in growth projects and boost earnings. Consumers may spend more, fueling demand. Stocks often thrive in these scenarios, particularly in industries like retail, housing, and discretionary goods. For investors, it's crucial to track interest rate trends and think strategically. Are we entering a high-rate environment where bonds look appealing? Or are rates falling, signaling a potential boost in corporate earnings and stock performance? Understanding the direction of interest rates isn't just helpful, it's essential for making timely moves. Quantitative easing and asset markets. Quantitative easing, QE, is a tool central banks use during tough times. When traditional rate cuts aren't enough to stimulate the economy, central banks buy financial assets, like government bonds, to inject liquidity into the system. Think of it as adding fuel to an economic engine that's stalling. What's the effect on asset markets? QE tends to drive up prices across the board. By purchasing bonds, central banks push yields lower, making them less attractive. This often nudges investors toward higher risk options, such as stocks, real estate, or commodities. Essentially, QE creates a wave of money searching for better returns, lifting asset prices with it. For example, during the post-2008 financial crisis, QE played a massive role in pushing stock markets to record highs. With central banks actively supporting economic recovery through asset purchases, investor confidence soared. Similarly, in the early days of the COVID-19 pandemic, QE helped stabilize markets and prevent a deeper crash. But there's a flip side. Over-reliance on QE can inflate asset bubbles, which may burst when policies tighten. When central banks eventually taper asset purchases or unwind QE measures, liquidity dries up, and markets can become volatile. For investors, understanding QE's mechanics can help you ride the wave without getting caught off guard. Are central banks implementing QE? That's often a green light for riskier investments. However, stay alert for exit signals when those policies change. Adapting your strategy as monetary policies shift can help safeguard gains while staying prepared for potential corrections. By keeping an eye on these central bank tools, interest rates and QE, you'll gain valuable insight into market movements and how they might impact your portfolio. Managing investments without this awareness is like sailing without a compass. You might get where you're going, but you're taking some unnecessary risks along the way. What's your strategy as central banks steer the economic ship? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.